Okay, so I can see a few more people are joining, but at this point I'd like to thank you and welcome to our first Rethinking Social Housing webinar of 2023. Over the next hour, we'll be exploring the concept of golden brick and how, if utilised correctly, developers of housing can secure VAT savings. Before we kick off, just to let you know that you will have the opportunity for questions at the end of the presentation. So if you have any questions, please do pop them in the Q&A box. You'll find that at the bottom of the screen, and we'll endeavour to answer as many questions as we can, and any we don't answer, we'll make sure to follow up with afterwards. The session is being recorded, and so we'll share that along with the slides within the next week. In terms of agenda, this is part of a two-part webinar on VAT reliefs and savings that are available when developing. Part 2 will be run next month. Details will be provided at the end of this session. Given that we have attendees with varying levels of knowledge and experience in housing, I'll start by setting the context of why VAT reliefs are so valuable and outline the concept of golden brick. Jim will go on to explain the specific criteria and issues that you should be aware of, both in terms of HMRC's perspective and practical points that you should be aware of. We'll also explore how and if the rules differ in respect of MMC, that's modern methods of construction, before opening up to Q&A. So in terms of basic concepts, why are we interested in VAT reliefs? Well, most of you will be aware that when developing houses or dwellings, as they're generically called, there'll be VAT on several items. The most significant cost is likely to be on land. But as organisations, how do you start to address this VAT cost? Now, many of you will be aware that there are various options available, some easier than others. The most common of these will be disapplying the option to tax. Now, although you as housing associations / RPs have the option of issuing a certificate to disapply that option, commercially this becomes complex and time consuming. It also means that ultimately with the delays, land sellers don't often prefer this option, and it means that that is likely to be irrecoverable, particularly if the dwellings are going to be used purely for rental purposes, either in terms of general needs or even market rent. Now, the alternative to disapplying the option to tax is to purchase brand new completed properties. Now, this could include completed Section 106 properties. I know these are still available, albeit in fewer numbers. Now, these completed properties will be zero rated, but the commercial issue here is that it means waiting until practical completion, and this gives an extended timeline. Now, increasingly, we feel that this is going to be a problem for funding purposes. Now, in particular for landowners, because the question that we're increasingly answering or being asked is, how soon can the landowner cash out, and how soon can an RP provider draw down on funds to pay for the development if they don't have the land? It's worth noting that the developer, for the purposes of our conversations, could be a third party independent landowner, or it could also be an in-house development subsidiary. Some of you will be familiar with the concept of design and build companies. So this is where the concept of golden brick kicks in. The VAT legislation allows zero rating of partly completed dwellings. But the critical question that arises is, at what point in the construction is that point reached, and how soon can the first zero rated payment be made? Now, sounds easy in principle, but the problem today is that there is no legislative definition of when golden brick is reached, and there is limited guidance from HMRC when you start to review the internal manuals and VAT notices. There are a lot of grey areas, and one size does not fit all circumstances. So in this scenario, we revert to experience and case studies. But before we move on to considering practical issues, it's worth summarising the basic principles. So golden brick refers to the earliest stage at which the sale of a partly completed dwelling can be zero rated. The VAT legislation allows the zero rating of the first grant of a major interest in partly completed buildings. Now, I've said that in a deliberately meaningful and slow manner because there are a number of important concepts in there, because these will drive what can be zero rated. But again, the question about at what point in the construction is that point reached, and how soon can a zero rated payment be made is not answered. Now, there are a number of fundamental conditions you need to meet. The first is that the sale must be of a major interest. Now, here we're talking about freehold sale or a lease over 21 years. Now, again, it refers to the sale of the site and not construction services, because both are zero rated, so don't confuse the two. When we talk about the sale must be by a person constructing, the interest must be in a dwelling, and the dwelling must be in the course of construction. So golden brick can be a real game changer in terms of reducing irrecoverable VAT in the right circumstances. Parties need to time transactions correctly and meet the specified criteria. Now, I suppose the question then arises is, well, what happens if we get it wrong? Well, getting it wrong will lead to VAT costs. Now, in addition to paying the VAT, you may then also be liable for penalties and interest, which ultimately impacts on your return on investment and, in the longer term, how many dwellings you can afford to provide. Now, Jim's going to take us through the key criteria and what we need to consider and do. Thanks, Jim.
Thanks, Brule. The subject of golden brick is seems like an endless learning curve, because the term means so many different things to different people. It's got no single unquestionable definition, so it's got a multitude of different ones depending on who you speak to. In preparation to this, I did a Google search and found more than 20 different definitions before I lost my enthusiasm for looking. I'll give you a few examples. When foundations have been poured was one. The first brick has been laid once you've done your foundation was another. And another one, which I think was slightly ambitious, when a golden brick contract has been signed. So some say it's when you put a spade in the ground or get to slab level. Others think there has to be a clearly visible property that no one can deny is a house or a block of apartments. Most of us have heard the definition of a course of bricks above damp-proof course. In fact, I've seen convoluted legal agreements where they've been drawn up to include references to actual numbers of bricks. I've never actually found out where the definition of bricks above DPC originated, but it's certainly stuck in VAT jargon, or if perhaps that's VAT folklore. So golden brick as a concept is open to interpretation. I happen to think it's a matter of common sense. Does something look and feel like a building under construction, or is it really just a piece of land with some stuff on it? I've heard the term superstructure used, and that when that's been explained to me, it does look and feel like a specific point has been reached in a development where something looks definably like a building or a dwelling. So what is the level? How high is the bar? So what do HMRC say about golden brick? The legislation certainly doesn't mention the term, but the relevant legislative words used are active and present. It says the first grant of a major interest by a person constructing. So the word constructing, not constructed. By implication, that means a partly completed building can be transferred zero rated. But partly completed is not defined in the legislation. So the next port of call is HMRC's published guidance. If you look at that, you'll actually find one reference to the actual term golden brick. This means HMRC are aware of the concept and even that they accept it. The guidance also talks about buildings clearly under construction. It references walls clearly visible, but not necessarily, interestingly, above the ground. So over the years, there's been various discussions with HMRC and advisors like ourselves on the subject. Personally, I'm not aware of any instance where HMRC have challenged zero rating in a golden brick transaction, but then I haven't ever asked HMRC about a transaction which I thought would fail my own common sense test. There isn't much VAT case law either on the subject, but what there is suggests that the construction must be visibly underway and that normally presupposes some work above ground level. So next slide. So as we've seen, person constructing status is key, absolutely key. Only the person constructing can make the zero rated grant of the major interest. The person constructing is usually the landowner, but it can be someone else, say a developer who's been granted a building license by the landowner. There can be more than one person constructing. So if party A starts the construction process and then transfers the dwelling or dwellings partway through that process and part complete to party B, then party B inherits the person constructing status. And that is, in a nutshell, a golden brick transaction. Party A has made a zero rated major interest disposal, and so party B can also now make a zero rated supply when it completes the construction process. One important thing to say here is that person constructing status can't be transferred between members of the same VAT group registration. And we've seen that in practice. To limit party B's expenditure, the golden brick may be delayed until quite close to practical completion, perhaps before the roof is added, if indeed that can be left to last, or something else which is crucial to completion. So hence the terms golden chimney and golden loo I've also heard. So the person constructing can play a partial role in the construction process. However, in many instances, the real aim is to make the transfer as early as possible in the actual construction process. So we've established the more complete, the better. Clearly, if HMRC's guidance is followed, which says walls clearly visible and construction underway, the more building that there is, the more demonstrable the golden brick. But what if you want to transfer very early in the construction process? This might be for funding reasons. You want the land in the RP, in the social housing organisation as soon as possible, or for commercial reasons, the developer doesn't want the financial risk of going too deep into the build process, or hasn't got the capital to do so. Whatever the reason, is the golden brick question then not how far into the process, the build process, does the transfer have to be, but how incomplete the building can the building be? What if the developer builds very little and the development is sold very early? What is the level required? Does counting the bricks work? What if there aren't any bricks involved at all? How many question marks are there? There's hundreds. Okay, so we know it's complicated, but surely there's a few things we know for certain that golden brick isn't. The first three on the top there, I don't think anyone can argue with that the top three are questionable. At the least, I'm waiting for a brave person potentially to pop up in the chat. Bare land or land with planning can't be considered, or at least not until the VAT law changes or HMRC revise their views and guidance. I've heard talk of HMRC granting special rulings to certain big players in the construction sector, but I've never yet seen a piece of paper to convince me that we could rely on it. I don't think there is any blanket golden brick ruling, and as I say, it may come down the line, and it may be aimed at RPs and the social housing sector, but it's yet to arrive. Similarly, if materials have been delivered to the site and nothing more, that's an indication of an intention to build, but not actual construction. Nothing is part complete there, in my view. As for the bottom three on that slide, I've always understood that it's got to be more than those ones. On foundations or slabs, for instance, HMRC's guidance does specifically state simply digging and concreting foundations is not sufficient. The same is true of groundworks and site clearance. They're all necessary and preparatory works, but they're not construction per se. And as for drilling and piling, would that convince an HMRC officer that represented walls constructed below ground level? I'm not sure it would. And sometimes taking the time to think, what would I say if I was an HMRC officer, can be helpful. So after looking at what it probably isn't, what about thinking what a golden brick might be, or what it would look and feel like? Building work must have started and resulted in something that's identifiable as a building. What little case law there is talks about it being a matter of substance and degree, whether what has been done on the land is sufficient to fall within the term constructing. HMRC's guidance talks about walls being visible, and also mentions that walls don't necessarily have to be above the ground. So what about a cellar or an underground car park in a block of apartments? That would probably pass an HMRC's test, and those kind of things are becoming more, certainly underground car parks are becoming more and more common. Remember, you will have the planning consent to tell HMRC, if they ever ask, what the building is eventually going to be. So if you've started on a build in any real sense, surely that will pass muster, won't it? Because you've got the building underway and you've got the planning to back up that it's going to be residential. And what about a lift shaft? I had a client recently made an exceptionally good case to me for that to qualify. So you have to build it first, he was saying, and a lift shaft has walls. So what's not to like? Again, you've got the planning permission, so you know that it's going to be residential, even if at the time of the transfer it may just be a lift shaft. So lastly from me, in this unashamedly deep dive into all things golden brick, is the conundrum of more than one plot, more than one building, more than one unit, possibly a mixed use site, say commercial below and residential above. If you're dealing with one of those, do you have to have started the residential floors above, or is it enough just to have started the commercial unit below? Maybe that would be one in the good old days when we got rulings from HMRC we could ask HMRC about. I'm aware of a ruling that somebody got that wasn't very helpful on that. But my thinking again is, if you've started the build and it's going to be residential, you've got the planning, it's going to be residential, then the building could be seen as part complete. Or if you have a phased development, do you have to start each plot? One situation I was asked about involved a two-stage residential development where phase 2 couldn't start until phase 1 was practically complete. And that was because of site access issues. So there's a commercial reason why every individual plot couldn't be started to partly complete or golden brick status. Can you look through that issue? Because it's one single development, you've got contracts to back that up, and again you've got the planning. Or would there be a possibility to carve it out into potentially 2 separate golden brick transactions? More simply, on a development of say 20 new houses, do you have to start all 20, or just say half of them to golden brick? What is the level? What's the test you have to pass? And what if there's exempt use pepper potted across a site? Again, golden brick is there, as Parul said before, to cater for, to manage exempt use. So again, question after question, and all sorts of different things to different people. So with that, I'll hand back to Parul.
Thanks, Jim. Just before we move on to the ideal world, I just wanted to ask you a few questions at this stage. So, you've talked about starting construction on a site, being above foundation level, etc. But does the construction specifically need to be on the dwelling, or can it be anywhere on the site? So, for example, clients have asked me whether they can do the 0 rating based on the fact they've started building the garages that accompany the dwelling.
Well, that was the point I was making about the mixed use in a way. But I would say, if you're building the garages, there's the block of garages that's going to serve a block of apartments or a number of houses. Again, you've got the planning permission, which prove that those are domestic garages to be sold or to be used in conjunction with the dwelling. So I would say yes, if you've built something that's going to serve the dwellings, even though in itself they're not dwellings, you've potentially got part complete buildings. It's very subjective though, and you don't know what HMRC's views would be, because one officer might think differently to another. Because there's no clear guidance and no case law, I think we just have to take we always say, we take every development on its own merits, and come to a view, and always the parties should talk to each other. So developer and RP in the situation possibly you're talking about, and obviously pictorial evidence, if you can get pictorial evidence so that you can make a cogent argument to HMRC if they ever query them.
Thanks, that's really helpful. Okay, so just moving on into how do we secure our positions in an ideal world. Jim started his conversation by starting with the issue of, well, do we see a lot of HMRC rulings in this area? Because typically where there's uncertainty, taxpayers have the right to go and seek rulings. But in reality, I think we see very few of those. We hear about them. We don't see HMRC actually providing those rulings. And in actual fact, there are a number of things that you can do to get yourself comfortable, because zero rating, as Jim said, is a question of fact and evidence. There's very little movement in that. Now, part of that will be around ensuring that the legal structure and the agreements reflect the intentions and the facts at play for each individual scheme. So those of you that have been involved in developing houses for a while will know that there's typically there will be typically a series of contracts, one for the design and build, where you commission a landowner or your own subsidiary to acquire the land potentially and start the design and build process to get it to the relevant golden brick, depending on the fact specification. There will be a sales contract that deals with the actual sale of the site, the part completed site that is still under construction. And alongside that, at that point, once the site has been transferred to the RP, there will be a construction services contract that kicks in for the completion of the development services to practical completion. So you'll see a series of contracts. Now, increasingly, we're seeing slightly different variations on how each of these elements of the land and the services is valued for various reasons, but typically they're the three types of contract that we see in play. Now, you also need to be clear on where you sit in the supply chain and at what point your VAT treatment needs to be determined. So as Jim alluded to, there can be several people in the development supply chain that can zero rate their interest. So the initial developer can zero rate. You as an RP can zero rate your onward sale to, let's say, a homeowner under shared ownership or market sale. And in between that, you may have a subsequent, an intermediate zero rated sale if you're using a design and build company. So there can be zero rated transactions throughout the development process. Be clear on which suppliers you're responsible for, get the valuation right, get the tax point right, and ensure that you meet the liability correctly. And as Jim said, you need to maintain evidence. Now, the first critical point that Jim referred to was that you have planning permission, and planning permission is for the right type of development, i.e. dwellings. If you have the planning permission in place, it's also useful to note that your deposit can be zero rated. Take care with phases, and as Jim said, actually practically speaking, take photos and keep as much documentary evidence to support your VAT treatment. Okay. In real life also, it is very likely that the whole scheme may not be entirely dwellings, and therefore you may be required to apportion the value of zero rating. So again, use a reasonable apportionment and keep records of that. Some of you will also, unfortunately, and this is a fact of life, potentially have abortive transactions. And again, subject to planning permission being in place, the VAT should be recoverable against your intended supply. there is ultimately, there will be circumstances where you might not be able to zero rate, because commercially you just cannot wait until you reach zero, the golden brick stage, or for relevant purposes, whatever it is, the fact pattern can't be met. So in those circumstances, you can explore securing a transfer of going concern treatment, in which case that it's disregarded for that purposes, or ultimately you'll have a standard rated sale. Now, on mixed developments, that's less likely to be a cost, where you can recover the VAT against shared ownerships or open market sales, but it will result in a cost ultimately for any exempt properties that you have. So those are the tenure types for general, affordable, even market rent. So they are the critical things that you should start thinking about in terms of getting yourselves into an ideal position. So just moving on to the next slide, please, Hannah. Some of you, I can see in the Q&A, have asked about modern methods of construction. Now, the conversations that we've been having up to this point have related to traditional development, i.e. brick on brick. Increasingly, and for various reasons, we'll see organisations adopting or exploring modern methods of construction. Now, it goes without saying, we're not going to be seeing the brick on brick analysis. So ultimately, what's the VAT liability and what is HMRC's approach in this situation? So fundamentally, what we're doing here is breaking down what is different about this construction process. So there have been discussions about this with HMRC. We've been involved in those with various industry groups, and this is where we are today. So many of you that are involved in this will argue that the actual factory process of pulling the panels together is the beginning of the construction and is a critical part of the construction phase. Unfortunately, at this stage, HMRC are not seeing that as a service, as a construction service, but rather a production and supply of goods, right? What they have accepted at this point is that they will accept and allow zero rating where the manufacturer is also the installer of the product, of the panels. So today, that makes arguably golden brick harder to achieve, because HMRC then say, well, actually the foundation process looks quite different, because if we're not putting brick on brick, at what point is golden brick achieved? So at this point, developers are essentially getting to foundation stage. We know that that is not acceptable under the traditional golden brick tests. What else? What is the minimum that developers will need to do? HMRC are in the process of trying to understand that at the moment. Now, whether they visit factories or complete site visits to understand how the process is fundamentally different, we'll just have to wait and see at this stage. But I think, given the uncertainty from a risk management perspective, you will need to start to consider at least doing something more than getting to foundation levels. Now, that might be, as Jim referred to earlier, putting up part of the superstructure that facilitates putting together the building. This is something that we're going to have to wait and see in terms of updates. But what is clear is that methods have changed, but HMRC's understanding of how the rules apply to those methods, they're still in the learning phase. So I would say in these cases, proceed with caution, and if anything, take more action rather than less. So if we're to summarise where we've got to today, is look, golden brick is eminently achievable. 0 rating at whatever stage in your development is appropriate for your commercial circumstances is possible, as long as the key criteria are met. So break it down, document, and ensure that each of the criteria you're monitoring. What it's also clear is this is going to be subject to commercial agreements between the developing parties throughout the chain. It goes without saying, every development is different. I don't think, I mean, opening up to Jim, we continue to see a variety of questions coming up around different scenarios. We're always being asked new things, Jim?
I think that's right, and I think I said from the start it was a learning curve. It's a learning curve for all of us because every development is different, and construction methods are changing. There's been a few questions come up in the chat which we'll probably look at one by one. But the modular point, the prefab point, is a good one, because I've got clients who they don't deal in bricks anymore. They have panels put together in a factory, so the slabs of concrete with half bricks in them, and then they get slotted into this. I mean, we've talked about superstructure. Again, golden brick means different things to different people. Superstructure means different things to different people. But if the superstructure is effectively a framework into which of these panels can be slotted, then on the face of it, if you've only got the framework without the panels in, and you're not using bricks per se, that framework could be walls clearly visible and construction clearly underway. So I think it's a movable feast, and it's changing all the time. And sometime soon HMRC guidance is going to catch up on this, or there's going to be case law which helps us. So that's one of the questions in the chat.
Yeah, I think that's what I was going to mention, that there was a very specific question about MMC, and if you have a timber frame, does the whole of that frame need to be installed? I would say probably not the whole of it, but certainly steps taken above foundation level to begin the setup of the timber frame would probably be reasonable. Okay, so if we move on now to Q&A, please. Okay, so we have a couple of questions here. I think some of them we have answered. So I think there are 2 questions here around if you have multiple dwellings that you are developing, how would you approach golden brick in that scenario, Jim? So do you need to start development on all the units?
Yeah.
Or
there's two good examples in the questions, which again I alluded to when I was talking about and more than one plot. So one of the questions is you've got 10 houses. Does each house have to reach golden brick? And actually, the questioner talks in terms of the scheme, an individual plot reaching window level. I mean, I'd actually say window level is clearly underway. I mean, you've gone past the DPC, for instance. You're then in this situation where you've got buildings clearly under construction, but not all of them. So if you've got 10 houses, possibly others in foundation would still be their land. Would you then have an apportionment, some 0 rated and some exempt? Or would you take a more bullish view and say you've got a single contract to build 10 houses and you've started a number of them? You've got significantly to window level for 3, 4, 5 of them. So that means the whole thing is 0 rated. I think certain developers certainly would be more bullish than others. And again, if HMRC picked it up, would they query it? Would they see it as a single transaction and single zero rated supply? Would they insist on the exempt apportionment? Would it depend on the amount of input tax at stake? So, and I think there's another question talking about 50 houses in phases of 10 and each one potentially zero rated when they reach golden brick. But the question that goes on to say, what if we only did one plot? I think one plot out of 50 might be, you know, just too few. It would be the bare minimum to get zero rated, to get golden brick status. My personal view is if you've got multiple plots, multiple units, you'd need to start a number of them, so more than just one, more than just a handful, to get beyond golden brick stage before you could safely zero rate the whole supply. Or indeed you could carve it out into, continue to carve it out into phases, or you could think of an apportionment.
So would that, sorry Jim, just to interrupt there, would that be driven by, could it also be influenced by the fact that you have one planning permission, there is a transaction for the development of one site?
Yes, you've got planning permission for the building of, or plan consent for the building of a number of units. So in the same way that you've got, say, a block of apartments, you would, and say it's just apartments, let's not confuse it with a commercial on the ground floor and residential above. Say it's all residential. To get golden brick, you only really have to start the ground floor. You don't have to go all the way up. In the same way, if you've got multiple houses, I'd say the similar line would be, you don't have to start each individual plot, but you do need to do more significant work than just one plot. That would be my advice to a client if they were asking for advice. But you've got single planning permission, you've got single contract. Normally, you've got a single build contract for the whole site. You're not going to engage different contractors for different plots.
Okay, thank you.
There's all sorts of considerations there. So someone else has also asked, is there a cost to zero rating? Well, I think the zero rating is the perfect situation from a VAT point of view, because you don't, there's no accounting for VAT on the supply, and you get full input VAT recovery on your expenditure. So zero rating is the solution. Is there a cost? Well, I suppose if HMRC query it and it falls back to being, some of the supply being exempt, it could cost you some of the input VAT that you'd recovered. But in actual fact, a zero rate supply is the best state of VAT that you can have. There's another question, Parul, popped up about part refurb and part new build. Want me to think about that as well? Because I think a refurbishment of an existing property doesn't qualify, so that it wouldn't qualify for the zero rating unless certain circumstances applied. So if it'd been empty for more than 10 years, for instance, or it was a refurb or conversion of a commercial property. But if you've got a development that is part refurb and part new build, then apportionment wouldn't be necessary, would be appropriate. So you're looking at what exactly are you starting with, what exactly are you ending up with, and maybe doing on a floor space or a cost-based apportionment between what's potentially zero rated as golden brick or new build and what isn't. So again, every situation, every case has got to be taken on its own merits, and every development is different. So that's why we as advisors would always say, can we look at the plans? Can we look at sort of mock-up pictures? What is on the site at the moment? What are you looking to achieve? And then, when you take it to market, what's it going to look like in terms of tenure? There's all sorts of questions that we will ask on specific developments, but the basic principles do remain the same.
Thanks, Jim. That's really helpful. At this point, I think it's appropriate to take possibly one more question. Jim, we've got time for one more question. And this is in relation to an in-house D&B company. And the question is it possible to draw down payments prior to Golden Brick and still tick the 0 rated box? This particular client's had advice in the past that they can take a deposit to support cash flow.
Yeah, I can answer that, and certainly going back to when I was talking about HMRC's views and what their guidance says, I did say that there was a specific part of HMRC's guidance which uses the term Golden Brick, and the specific part in the guidance is actually in relation to deposits. So it says that you can 0 rate if you've got a 0 rated transaction, and it's going to be a Golden Brick transaction, and you know that at the time of supply there is going to be a building that's part complete, and that building is going to be a dwelling or dwellings, then that 0 rating, which will apply to the transfer when it happens, also would apply to the deposit when it's taken, because that deposit is anticipation of the 0 rated supply that's going to take place and nothing else. So it's quite useful that HMRC do specifically mention in their guidance the term Golden Brick when talking about deposits. It's one of the more helpful bits of HMRC. Not that HMRC's guidance isn't always helpful, perish the thought, but there are there's occasions when it's very specifically helpful, and that's one of them.
Yeah, thank you. Okay, I think that brings us to the end of the VAT questions. I note that there is one question on corporation tax, so we'll respond to that post this event. What that brings me to is the end of this session, and to thank you for your attendance. At this stage, I think, Jim, you answered the question about apportionment on refurbishment versus development, and that actually leads us directly into part 2 of this webinar series on development VAT reliefs. So on the 9th of February, for those of you that are interested, we'll be covering other reliefs available during the course of construction, and that might include relevant residential properties, relevant charitable properties, i.e. so where we're not dealing with dwellings per se, conversions, adaptations, reliefs available for energy efficiency, retrofitting. Now that's going to be led by my colleague Glyn Woodhouse and Chris Evans. For those of you that are interested, or you may have colleagues that are interested in getting tips on how to prepare cash flow statements, our audit colleagues will be running a session on the 7th of March, and something that's very topical and applicable to many clients in this sector is dealing with the complexities of national minimum wage. Now, these rates are due to increase from the 1st of April, so we're running a briefing on the 8th of March, and this will help you understand, again, the challenges, and my colleague Caroline Jones will be providing practical guidance on how to prepare for those increases. So again, can I take this opportunity to thank Jim? Thanks for bearing with us with some of the IT challenges, but I think that's just something we have to face. And please do register for the upcoming webinars, and we'll be circulating a copy of this recording and the slides within a week or so. Thank you.
Thank you.